Thank you very much. And thank you for joining this afternoon's presentation on Horizon Oil. I'll give an overview of the company, a high-level overview of the company, our assets, recent financial performance, and then I'll close with a near-term outlook. The company itself is relatively straightforward to understand. Our focus area is Asia Pacific, with operations in China, New Zealand and Papua New Guinea. Our cash flow is generated in China and New Zealand. We have approximately just shy of 27% interest in the Block 22/12 field in offshore China. We've been there since the commencement of production. And our partners there are CNOOC and Fosun. In New Zealand, we have a 26% interest in the Maari field offshore New Zealand. Our partners there are Q, and that's operated by OMV. Some of you will have heard Matt Boyle's presentation yesterday on Maari. That field's been doing particularly well over the last year or so. We also hold significant positions in a very material gas condensate resource base in Western Province, Papua New Guinea, in the Foreland area, and that is as yet undeveloped. It sits very close or adjacent to the planned pipeline route from Exxon's Penyang field in Western Province that will be ultimately flowing to Kutubu and then into the PNG LNG scheme. It's the underlying volumes for the PNG LNG expansion. So we tend to hold material positions or substantial positions in assets that we seek to anyway. That gives us the opportunity to exercise some appropriate technical and commercial influence, and that's held us up well. We've got very good technical engagement with our partners who operate as CNOOC and Fosun in China, and also with OMV and Q in New Zealand. We operate a number of fields. In fact, we operate the Elevala Ketu field, which is essentially the largest uncommitted gas resource in Papua New Guinea. I'll talk a little bit more on those assets shortly. And PNG's been topical. We've seen the recent advocacy of the PNG government or demands essentially for third-party access to pipeline infrastructure, some of the expansion infrastructure for the LNG fields, and also demands for greater domestic market obligation into PNG. Now this provides us some opportunities to work with those players to ideally have our gas evacuated through and condensate through their pipeline and potentially meet some of their domestic market obligations that will arise as the country's industries demand more access, as is the case in Australia, greater access to hydrocarbons. 2019 was a very good year for the company. These results were released a few weeks ago. We had our sales from China and New Zealand were 1.87 million barrels. It was a significant lift from what has been a progressively improving sales volumes over the last 5 years. There's a chart later in the presentation that'll demonstrate that. So generating from that good cash flow, and I'll present all these numbers in Australian dollars, US dollars, sales revenue of $122 million. That just by way of an indulgence, that equates to our market cap today. We generated record EBITDAX as a result of that strong production performance and obviously the revenue. We have these fields are very high margin in China and New Zealand. Our average operating cost is less than $20 a barrel. So at $63 oil prices, we're throwing off the strong free cash flow. That allowed us to reduce our debt. We had development and acquisition funding that has been the focus of the market for a number of years, but we were able to aggressively address that and take that down, as well as refinance our facility, debt facility. Our margin on that facility is 2.75% over LIBOR. So we've got a good funding support, but we're aggressively taking down that debt. All the free cash flow has been applied to that debt. And that we on this trajectory, we'll see ourselves in a net cash position by the middle of next year, middle of calendar 2020. The very strong performance of our fields and in fact, some of which was a little better than had been anticipated, and together with some planned improvements to our water handling capacity in China, and the continued demonstration of the strong performance of the water injection system at Maari, which was recently been enhanced by the conversion of one of our production wells to an injector well that allows us to inject 25,000 barrels of water a day into the field, allowed us to increase our 2P reserves by a net 1.8 million barrels, essentially replacing the significant sales that we had during the year. So they're the highlights for the year. If I take you through a corporate snapshot, the points I'd like to make here are, you see that a strong production performance is coming from New Zealand and China, where we have 8.8 million barrels of 2P reserves. It's all developed producing reserves. But that is just a fraction of our 2C resources, the bulk of which is composed by our interest in Papua New Guinea, where we have the 600 BCF of gas and approximately 20 million barrels of condensate. And if we look through, again, indulge me, if we look through our EV to EBITDAX, we're approximately 1.6 times, which for many of you in the sector and in the audience will appreciate that is unusually low. Some of that is a function of the perception of the considerable debt we have. As I've mentioned, we've addressed that and taken it down, all with internally generated cash flow. That net debt now, as I say, is less than 1/3 of our. In fact, it's less than $28 million now, but it's less than 1/3 of our financial year 19 EBITDAX. If I touch on the board, we've got a very, as many companies here have, a very experienced and skilled board. They're very complementary skill sets amongst the board. We underwent a bit of a renewal process in our board over the last 12 months. Mike Harding joined the board as chairman, and Chris Hodge is here today, came on earlier this year as a non-executive director. Many of you will likely know Chris and some, no doubt, Mike Harding. Block 2212, China, Horizon Oil has been there from the outset. We've been through the development phase, which went extraordinarily well. As I mentioned, CNOOC is our operator and partner there, together with Fosun and a small Korean company. Horizon holds the largest non-CNOOC or non-state interest at 26.95%. This field has been on production since 2013. It's been a tremendous field for us. One of the points I'm often asked is, well, do you have any trouble getting your money out of China? And since the commencement of production, we've had what happens. Our crude is produced. We produce from 4 fields and 2 platforms that tie into this platform here, and then go by way of pipeline up to Weizhou Island and are sold in the Chinese market. Now, our product is metered through, goes through the meter on that platform each month, tallied up, and we're paid US dollars offshore bank accounts. That keeps our bankers very happy. But that's been we've had a tremendous experience with CNOOC. Again, with the increase in sales and underlying production has been tremendous, and that's been driven in a large part by the very successful infill wells that were drilled in August last year. They came on quite a bit higher than predicted, at 3,500 barrels a day. We've also seen CNOOC addressing some water handling issues, just giving us the capacity to deal with more of the water, and that, as I mentioned earlier, led to the ability to upgrade our reserve position. The operating costs, as noted, they're tremendous, at less than $10 a barrel. So again, this is a core free cash flow driver for the company. This asset and the joint venture will continue to look to improve the performance of the field with the workover program that's underway at the moment, together with some near-field appraisal that will be undertaken later, in the next quarter. In addition to that, CNOOC will be installing some additional slots on our 612 platform. That's the northern platform, and that will allow us the capacity to drill some infill wells. That we hope to have similar success to that which we had in August last year. We have here you'll see, and we've talked about it before, the 12-8 East field. That's a complex field, and CNOOC has addressed the potential development of that field in a novel way, with a very accommodating commercial terms. We'd be able to lease one of their platforms that allow us to reduce the upfront capex. And also, their subsidiary COSL would conduct the drilling of the first 7 wells under the program under a turnkey basis. We're still working through our and the joint venture, I should say, is working through the assessment of the subsurface. As I mentioned, it's complex. We look to make the financial investment decision later this year. And if we proceed, CNOOC's target is to be on production in the first half of 2021. In New Zealand, the Murray field is the largest offshore oil field largest oil field in New Zealand. It's offshore off the North Island of New Zealand. Again, Horizon has been in this field since 2002. We joined with 10% in farming with an appraisal well, and we've been through the development and a growth project. At the beginning of last calendar year, we acquired an additional 16% of the field, taking our position to 26%. We've seen, as a function of that additional interest, and together with some optimisation work that OMV has done, and the sustained and demonstrable improvement of production from the water injection and the enhanced water injection, led to us achieving a 33% in our net production entitlement in the year. So we're seeing Murray, and as Matt showed yesterday, we're seeing there's an expectation of sustaining those production levels consistent with current rates, with decline mitigated by further optimisation work, and we now have a better understanding. We're gaining a better understanding with the installation of multi-phase flow meters as well. That helps us in a field that has been on production since 2009. With many years to go yet, at least another 10 years to go from our perspective. It gives us the opportunity to work and drive this field a little better. There's very good engagement between, as I mentioned earlier, the whole joint venture. There's been tremendous reception from OMV over the last year particularly. And they've addressed some of the cost structure. We now have operating costs at around $25 a barrel, which for an offshore field in an OECD country is quite good. We own the FPSO on the field. We're not subjected to extraction of economic rent by by FPSO providers. Again, for the outlook, we'll continue to work this field. There's a lot of life in it yet, and I think I've hit all the high points. We're currently in the process of working over the MR3 well, which, as Matt mentioned, will increase production. We should be closer to 8,000 barrels a day by the time that workover is completed. Papua New Guinea, this is we have a big position, as I mentioned. We're in the Foreland Basin. The topography there is far more benign than what you see on Oil Search's magnificent photographs. You can see this green line here delineates the highlands from the Forelands. As you can see here, the Panyang gas field has 4.4 Ts and about 70 million barrels of liquids. The Exxon has gazetted a gas and condensate pipeline route that will run from here out of the highlands into the Forelands, within about 8 kilometres of the Ketu field, and then round to Kutubu. That won't be on production, and it's not expected to be on production until 2028. They are the volumes that will underpin expansion train 3. But as you can see, it runs straight past our fields. Exxon and the government has been quite insistent, as you will have seen in recent media, particularly in relation to the Papua LNG gas agreement with a new government coming in. They reviewed that document. It went the way it should have gone and was meant to go, that the gas agreement was endorsed. But a key feature, and what the government was particularly vocal about, ensuring that there's the capacity for there is third-party access, or the possibility of third-party access, I should say. And in addition to that, again, the calls are strong calls for greater domestic market obligations. There's no, under the existing PNG LNG scheme, there's no domestic market obligation. But what's risen under Papua LNG, there's a domestic market obligation that's been agreed of about 5% of production. There's a price for that DMO of $4.50 a gigajoule in Port Moresby, but that's only to be used, at least for the first 4 years, as I understand it, the first 4 years of the production for electrification. And it's a very low demand, so I suspect that I won't be drawing down on all of that 5%. However, there is a burgeoning demand in PNG for gas for industry. And there are many parties, international parties, that would like to access that gas. So that will continue to be a feature of the negotiations. Certainly will be a feature of the negotiations for the PNG LNG agreement, and that's again with a potential dilution of some of the gas resource that they require for their LNG development. The proximity of substantial gas and complementary gas resources. As I say, we've got 4.4 Ts at 4.4 Ts at Penyang, while there's 2.2 Ts in our resources here. Stanley Alavalakita will be quick. We have 1.6 of those 1.6 Ts of those resources, and all the liquids are in the northern blocks. I'll move through this. I touched on that demonstrates the movement of our reserves and over the year. Financial summary, again, I'll go through this briefly, but the key points I'd like to make here is that we've seen over the last 5 years progressive increases in our oil sales, and that's led to considerable revenues that have been thrown off. We've seen part of that's been driven, as I mentioned, by the additional interest in Maari, but also by the greater performance of the fields, the underlying performance of the fields. EBITDAX, the earnings and profitability of the company are demonstrated in these two slides, with EBITDAX of $93 million US. That's been a tremendous outcome. We've seen operating cost per barrel, as you can see on this. Well, I said under 20. It's just over 15 on sales, but we'd like to stay in that range of under $20 a barrel. We doubled our. There's a nice thing. We focus on cash flow, but it was nice to see the underlying profit doubled year on year. Free cash flow generated, it's clear here that we've thrown off a lot. That's been applied directly to take down the debt, and you can see the considerable movement over recent years to take it down to $28 million will be net cash, as I mentioned, in the middle of next year. So finally, outlook. Focus will be to work the existing assets we have, pursue and promote the production enhancement opportunities, and joint ventures working on that. As I mentioned, the infill opportunities, greater focus on water injection at Maari, appraisal drilling near-field appraisal drilling in China, with the ability to tie back that directly to existing infrastructure. Operating costs, a continued focus on maintenance of low operating costs. That cash flow, I won't dwell on that. We're strengthening balance sheet clearly, and I won't mention for a third time, or maybe I will, that the net cash position by mid-2020. Key task is to commercialise the PNG asset base. We will see some regional development occurring in the near term, and as has been flagged by us earlier, and it's in the market, Repsol will be selling down its interest that it inherited when it took over Talisman in the PNG asset base. Those factors, who comes into the joint venture and the regional development, will have an impact on the manner and timing of our commercialisation opportunities in Papua New Guinea. So with that, given a very strong cash flow position that's generated and that will continue to be generated from our existing assets, and a go-to asset that's big, it's appropriate for us now, as we get with the strong balance sheet that we have, to look to opportunities to complement our existing asset base, and we will do so. That's the focus of management and the board on looking for opportunities that will allow us to grow the company while we also deal with the commercialisation of PNG. So thank you.